We unfortunately currently live in an era of propaganda and false narratives. Luckily, none of that has affected the passage of time, and it doesn't erase burdens already borne. So, when you figure things out ahead of everyone else and you've actually already built out products aligned with real near future necessities, it's very hard for competitors to catch up. Ready? Let's go. We're going to talk about Washington and a lot of crypto, realizing all at once that digital identity is important, no crucial for regulatory compliance in crypto. Cardano stake pools vastly outperforming Ethereum stake pools. A competitor apparently going offline once again. Plutus Scripts doubling on chain, and the world officially accepting what we've been talking about for months with Evergrande. This is Brian Brooks. He's the CEO of Bitfury. Bitfury makes all kinds of hardware and infrastructure for Bitcoin mining. Brian Brooks also used to be the acting US comptroller of the currency, which basically means he was in charge of banks, the former CEO of Binance.us, and the former chief legal officer of Coinbase. He was kind of the hero on the crypto side of the House Financial Services Committee crypto hearings yesterday, and that was discussed a lot online, rightfully so. But the reason we're talking about him right now is that he was also the witness who sort of presided over the part of the hearings, one part of the hearings that were very interesting for all of us in Cardano. So the topic came up about compliance and how this can happen. And he described a pair of sort of conflicting necessities or desires. One of them is for platforms like DeFi platforms and also other platforms to be able to verify that a wallet is a compliant wallet. It's not a wallet involved with terrorist financing or narco financing or, whatever type of blacklisted, economic actor you can imagine. We've got that in one hand. In the other hand, though, he described, I think perfectly, that we also don't want everybody using crypto to have to divulge their name and taxpayer identification information, like their social security number or their taxpayer identification number, every time they want to send funds into their wallet. He started describing a new technology, and you could tell a lot of people in the room were amazed, including, probably all of the House reps, all the Congress people on the committee who actually understood what he was talking about. He started describing new technology that he said was being developed by technologists, an interesting euphemism, but new technology that would allow you to verify that you are in fact a compliant wallet, not a terrorist, not a narco trafficker, not any of these bad actors, without actually divulging your name and your social security number and all those kinds of things. And he mentioned that this was sort of in development. If you were watching this from a Cardano perspective and you understood what he was talking about, you realized immediately he was talking about something that sounds an awful lot like a Tala Prism. And of course, there are other groups in the crypto space who are probably also developing digital identity technology, basically writ large. But what he's describing is exactly the role that a Tall Prism plays. Of course, he's the CEO of Bitfury, which is, as we've described, heavily focused on building out infrastructure for Bitcoin mining and has kind of always been in that space, but is also, invested in a lot of other things. So, of course, he doesn't have any incentive in singling out the blockchains that have already built out this technology. He just says it's sort of under development by technologists, which is a nice euphemism, but it's very obvious that Cardano fits squarely inside that wheelhouse. And in fact, we're not just developing it, it's already developed. It's already deployed even at the nation state level in Ethiopia. We've already got this. We're already ahead of the curve. When the rubber hits the road and the policymakers in Congress start trying to figure out exactly how they really want to regulate crypto. And yesterday we talked about how this might be kind of a watershed moment, kind of a turning point when they realize they need to regulate crypto responsibly so as not to chase innovation offshore. When we get past this threshold, all of a sudden the question is not should crypto be banned, not banned. It's how do we identify KYC, AML, Bank Secrecy Act compliant wallets versus those that aren't. And these are the kinds of issues that Cardano has been thinking about all along. A tall prism is just one example of this, but we're going to see things like this come up over and over again, I think, over the next several years. Everybody can hear Rick McCracken gives us another example of this phenomenon. Building out getting to Shelley, building out Ouroboros staking such that stake pools would never involve the stake pools taking custody of your assets, where a stake pool was incapable of losing your ADA for you. That took a long time. It took us a long time to get to market. A lot of other projects beat us to proof of stake, and even Ethereum now already has staking. But Cardano was built out such that the stake pool can't lose your ADA. And here, Rick McCracken posts a little chart that asks a simple question: how much ADA has been lost in the course of staking in Cardano? And the answer is zero. In Ethereum 2.0 staking, which already exists, $163 million have already been lost. It would have been really easy for Cardano to get to staking faster by building out staking where the stake pool takes custody of your stake. That would have been easier. But then we have this result and this bottom result, $163 million lost and not the zero lost. But again, Ethereum can't go back in time and rebuild their staking mechanisms so that this doesn't happen. It's too late now. The work's already being done. They can't go back and erase this advantage for Cardano. We're already ahead. Ethereum just barely finished their proof of stake system. I mean, they barely finished the ability to stake in Ethereum. Obviously, Ethereum 2.0 is not a reality yet in whole, but the ability to stake on Ethereum is pretty new. And Cardano is already so much further ahead than Ethereum because we don't have these kinds of losses. Another example, this morning we saw reports like this. Breaking, Solana crashed again and is currently offline. Engineers are looking into rebooting the system. Here was another report. We are aware tokens are taking a long time to distribute. The Solana chain is being overloaded with DDoS attacks, which have clogged the network, causing delays. Please be patient. And down below, people ask the question, wait, so your supposedly decentralized blockchain is getting DDoSed just like a centralized platform, which may be unfair criticism. I think we all realize that you can spam blockchains, but still, we saw Solana zoom up the charts, and the big rallying cry was transactions per second. We won't even address the criticism of their transactions per second claim that we've covered in the past that are again highlighted down below here. We've already discussed all those issues, but not even addressing that. It seems that whatever they did achieve, and they did achieve a certain spot in the charts, a certain market cap. They certainly achieved that. But whatever they did achieve, it seems like they may have done it by sacrificing certain levels of stability and maybe decentralization. They would argue probably both those points. But what we have seen is we've seen these reports of outages in the Solana blockchain, and we just haven't seen this in the Cardano blockchain. There have been little things here and there, but they weren't things that the users really noticed. And there were things that stake pools barely noticed, very short lived and very low impact. But with Solana, we've seen these outages where the users are coming out of the woodwork complaining about the outage. It seems to be serious stability issues when these outages occur. And there's been a huge amount of criticism leveled at their level of decentralization. But again, Solana can't go back now and start working on a blockchain that solves the blockchain trilemma to the same extent that a lot of us would say the Cardano blockchain has solved the blockchain trilemma. Cardano doesn't seem, they took the time to actually build a blockchain that doesn't sacrifice security. It doesn't sacrifice decentralization. And it seems to have achieved a very high level of stability along with those things. Solana can't now go back and start building a blockchain that solves a blockchain trilemma at the same time Cardano did. That time period's gone. There's no going back. We find ourselves here in December 2021. Cardano has a blockchain. Cardano has a blockchain that does these things. And the blockchains that didn't take the time to build that out, they just don't have that. They could, I guess, rip everything apart and start building again, but I think we all know that's not really going to happen. So why doesn't the market reflect Cardano being so far ahead of its peers? First, because these things are complicated. The market is an aggregation of the chaos of a huge multitude of actors in the market. And these actors, we're talking about human beings here. Of course, there are bots doing things in the markets, but at the end of the day, we're talking about human beings here, and these are complicated things. Most people, even if they're invested in crypto, buying and selling crypto, they don't understand the difference between custodial and non custodial stake pools. They don't understand what delegated proof of stake is. They don't understand how this Ethereum was lost in these stake pool hacks or whatever they were. They don't even want to know. They just want to buy these crypto assets and watch them go up and down and make some decisions about when they dispose of those assets. They don't understand the blockchain trilemma, not even remotely. And they certainly don't understand things like the difference between an account balance system and an EUTXO system and why Solidity differs from Haskell. These are all things they don't understand and probably don't care to understand. The other half of this is that they haven't yet had a chance to see the other side of the coin. All they've seen is Ethereum and now Solana and a few other blockchains. If they've used DeFi, it's been on these pre-existing blockchains. They haven't seen Cardano DeFi. They haven't seen Cardano dApps because those things are just about to launch. I mean, we have the first hotly anticipated DEX on the testnet. It hasn't even launched on the mainnet yet. That's all about to happen. The participants who in the aggregate make up the markets or, you know, introduce the data that's aggregated into the markets, they aren't going to go out and learn about the underlying technology, maybe a tiny bit, but they're not really going to understand it. They won't really understand the difference until the Cardano blockchain unfolds its cells and is on the open seas. We're just at that point where things are going to start launching. And we're already seeing it in the data. So here we have a post from the Cardano Foundation. Significant increase in the number of Plutus-based smart contracts on the Cardano blockchain. And they've posted a chart here on Plutus Scripts. And you can see this goes from a number in, I can't tell if this is supposed to be the beginning of December on this chart, probably around the beginning of December. You can see the number of Plutus Scripts are below this 400 level here. And now in the middle of December, maybe, I guess we're at December 9th. So really still the beginning of December, we've already doubled the number of Plutus Scripts on chain. It looks like this data was pulled from Cardano Blockchain Insights, but can you imagine what this is going to look like in a year, 2 years from now? All those smart contracts will be out in the wild, and people will actually be able to see, they'll actually be able to experience and feel this lead that Cardano has built up by taking their time and building for correctness first, just to get to this point. In news that could impact all of crypto, it looks like the rest of the world is suddenly becoming a lot more focused on something we've discussed for a long time on this channel, and that's the very bad situation Evergrande finds itself in China. Here we see CBS News running an article titled "Evergrande Defaults on 1.2 billion in foreign bonds," Fitch says, as China intervenes in debt-ridden real estate sector. We already knew that Evergrande didn't make the payments, but Fitch is now making it official, and they're saying that Evergrande has defaulted on 1.2 billion, and Kaisa has defaulted on an additional 400 million. They're another real estate company in China. What's interesting about this is that even though everybody kind of knew this was coming, it's sort of just now making the news that this is actually relevant for the rest of the global economy. I've been saying on this channel for a long time that the second biggest real estate company in the second biggest economy in the world defaulting, collapsing, whatever ends up happening is pretty relevant for the global economy. It looks like that sort of idea is being taken more seriously now. Here we have Janet Yellen, Secretary of the US Treasury, telling the reporter, real estate is an important sector of the Chinese economy. It accounts for about 30% of demand. So think about that for a second. We're talking about 30% of demand in the second biggest economy in the world. She says a slowdown in China, of course, would have global consequences. China's economy is large, and if China's economy were to slow down more than expected, it certainly could have consequences for many countries that are linked to China through trade. To understand just how big this might be and what might happen next, I like this article from Zero Hedge called Evergrande has finally defaulted. Here's what happens next. But even more than the article, I really like this diagram right here. This chart identifies Chinese real estate as the biggest asset class in the world. You can see this is real estate in China. This is fixed income. This is equity. In the US, same thing, real estate, fixed income, equity. And then we see Japan, the UK, and Australia. Look at this thing. Chinese real estate, in terms of value in trillions of dollars over here, is at 62. The next biggest number on the chart is US fixed income at 48 and US equities at 47. Chinese real estate is at 62. And what we're seeing is the second biggest company in that, basically in that asset class, the second biggest company is failing to meet its obligations. Zero Hedge points out that China is a country where as much as 75% of household wealth is tied up in real estate. And this is sort of intergenerational wealth. So the real estate is so expensive, people are aggregating their money with relatives of different generations just to afford to invest in real estate. But three-quarters of the country's household wealth is now tied up in real estate. And Zero Hedge tells us further, China's housing slump has intensified in recent months after sales plunged and home prices fell for the first time in 6 years. Of course, we've previously discussed how the three red lines policy put in place by the Chinese government last year reduced how leveraged these real estate companies could be in China. And that's kind of what catalyzed a lot of these problems for companies like Evergrande and Kaisa. But this slump in real estate in China, prices dropping for the first time in 6 years, is definitely not helping. So if you have this asset class that makes up 75% of the household wealth of this gigantic economy, which is kind of like the engine of growth of this crazy growth in the global economy. And that asset class, three-quarters of the household wealth, suddenly starts slipping backwards a little bit. And the biggest companies that are involved in that asset class kind of start defaulting on their obligations. You find yourself in a potentially perilous situation for the entire global economy and all asset classes. So let's keep our fingers crossed that this does not eventually make its way to the shores of crypto. I hope you're going into a great weekend, and I'll talk to you soon.